The jobs report arrives each month with a simple headline, but its impact runs deep. Markets watch it closely because employment data reveals the real temperature of the economy. A strong labor market signals resilience, while weakness shows stress building under the surface. This report often reshapes expectations for growth and inflation, and that shift moves every major asset class. Investors know this pattern well. They also know the first reaction often hides the deeper message. Let's pause for a moment. The data forces traders to reconsider how tight financial conditions truly are. It also pushes them to reassess the timing of future rate cuts. The Fed studies the same numbers, yet their interpretation works on a longer timeline. This is an important point. One monthly reading does not set policy, but it can tilt the balance. It can change how the committee thinks about pressure in the labor market. That is why the latest report matters. It arrived during a sensitive phase for markets. Expectations were fragile. Small shifts could carry big consequences. The latest jobs report delivered a mix of signals that demands careful interpretation. The headline number showed steady job creation, which suggests the economy still holds momentum. Wage growth eased slightly, which reduces pressure on future inflation. This combination often points to a cooling but not collapsing labor market, yet the details matter more than the headline. Let's pause for a moment. The report showed a modest uptick in unemployment, which reflects softer hiring conditions. It also showed more people entering the workforce, which adds nuance to the story. A larger labor pool can slow wage gains, and that change influences how markets read inflation risk. This creates a picture that is neither strong nor weak, and that ambiguity is important. Investors sometimes want a simple message, but the economy does not always offer it. Instead, the data hints at a slow transition. It suggests demand is normalizing while supply adjusts. The Fed watches these shifts closely. Moderate job creation, paired with cooler wages, aligns with their desired path. It signals that policy tightening has reached deep into the labor market. This is an important point. The committee wants balance, not contraction. They prefer an economy that bends without breaking. So what do the numbers really say? They reveal a labor market losing heat in a controlled manner. They also reveal a system that still supports growth. The challenge now is to understand how long this balance can hold. That question will shape the next phase of the policy debate. Markets reacted quickly because the jobs report arrived during a fragile moment. Traders watched every number closely since expectations were stretched. The first move appeared simple as yields slipped and futures priced modest relief. This reaction reflected the softer wage growth which eased short-term inflation fear. But the second wave told a deeper story. Let's pause for a moment. Equity markets turned mixed because the data did not confirm a clear trend. A softer labor market can support lower rates, yet it can also signal slowing demand. Investors weighed these possibilities, and the result was hesitation. Bond markets moved with more conviction. Lower yields showed that traders saw the report as slightly dovish. This matters because yields guide risk appetite across assets. When yields fall, financial conditions loosen and liquidity flows more easily. This is an important point. Even a small adjustment can shift market tone when uncertainty is high. Currency markets added another layer. The dollar weakened, which suggested global traders expected the Fed to soften its stance. A weaker dollar often supports risk assets, but it also signals doubt about U.S. growth. The mixed signal reinforced the idea that the report was neither strong nor weak. So the market response was fast, but it was not final. It showed initial relief, followed by cautious reassessment. Investors understood that one report can move expectations, yet it cannot settle the full policy debate. More data will shape the next move. The Fed studies labor market dynamics because employment pressure often reveals the true direction of the economy. Job creation, wage trends, and participation rates tell a deeper story than surface-level market moves. These indicators help the committee judge whether demand is cooling in a controlled path or slipping too fast. The latest report fits that framework because it shows moderation without clear signs of stress. Let's pause for a moment. The Fed does not react to headlines. It reacts to patterns that build over several months. A single report can shift probabilities, but it cannot rewrite the entire reaction function. The committee looks for consistency across data, and that process takes time. This is an important point. Policymakers need confidence before adjusting the path of rates. The labor market shapes that confidence in a very direct way. Strong hiring can keep inflation sticky because wages support consumer demand. Softer hiring cools demand and gradually lowers price pressure. The current mix sits between these extremes. It shows an economy that is slowing yet still stable. That balance reduces urgency for rapid policy shifts. Markets often forget that the Fed operates with caution. They know policy acts with long lags, and they understand that premature easing can reignite inflation pressure. This is why the committee studies each labor detail carefully. Participation trends show how supply is responding. Wage data shows how quickly pressure is easing. Unemployment levels show where weakness may emerge next. So how does this shape the reaction function? It nudges the Fed toward patience. It encourages them to wait for confirmation rather than chase market expectations. The latest report supports that posture because it signals progress without risk of a sudden downturn. The committee sees a path that bends slowly, and they prefer to protect that path. Policy works slowly because interest rate changes move through the economy in stages. Consumers react first as borrowing costs reshape household decisions. Businesses react next as credit conditions tighten and investment slows. These shifts take months to appear in the data. The Fed understands this timing well. They know the economy is still absorbing past rate hikes. Let's pause for a moment. The latest jobs report shows moderation that likely reflects decisions made earlier in the year. This is an important point. Current data often reflects old policy rather than new expectations. Because of this lag, the committee avoids abrupt moves. They prefer to observe how conditions evolve across several reports. A single month can offer insight, but it cannot reveal the full impact of prior tightening. This slower rhythm protects the economy from unnecessary volatility. It also prevents overreactions that could push growth into contraction. Markets sometimes overlook this delay. Traders operate on short horizons and react quickly to each data release. The Fed operates on a much longer horizon. They judge momentum, not noise. When labor indicators cool gradually, the committee sees progress toward balance. When cooling appears too sharp, they worry about risk spreading across the economy. So the latest report fits the Fed's patient stance. It shows moderation without instability, which reduces urgency to shift policy. It also confirms that past tightening is still flowing through the system. The committee will wait for additional reports before adjusting their message. That patience defines the mechanics of policy lag, and it shapes the coming months. Bond yields reacted quickly because they sit at the center of market pricing. When yields fall, financial conditions ease and risk appetite improves. When yields rise, conditions tighten and growth expectations shift. The latest jobs report created a gentle pull lower which signaled modest relief. Let's pause for a moment. This move matters because yields influence every major asset class. Equity valuations depend on discount rates, and those rates trace back to Treasury yields. A small adjustment can lift the entire market or weigh on it when uncertainty rises. This sensitivity becomes more visible during macro turning points. Credit markets felt the change as well. Lower yields reduce funding pressure for corporations, which supports issuance and stabilizes spreads. This is an important point. Credit behavior often reveals how investors view long-term risk. Easier conditions suggest confidence that growth can slow without collapsing. Commodities added a separate layer. A softer dollar made prices more stable, which reflected shifting expectations for U.S. demand. Oil stayed range-bound, which implied balanced growth assumptions. Gold found support because lower yields reduced the opportunity cost of holding it. Each asset reacted differently, yet all traced their direction back to yield movements. The ripple effect extended into global markets. International currencies adjusted as investors recalibrated interest rate differentials. Emerging market assets gained some breathing room because softer U.S. yields reduced pressure on capital flows. These shifts show how one report can influence global positioning. So the market's yield sensitivity played a central role. It translated a moderate jobs report into broad but controlled adjustments. The moves were not dramatic, yet they carried meaning. They showed that investors remain focused on the yield curve as the primary signal of policy direction. The market now enters the next Fed meeting with a clearer but still delicate framework. The latest jobs report eased pressure without signaling weakness, which gives investors room to breathe. It also lowers the chance of unexpected tightening because the data showed steady progress toward balance. That shift supports a more stable outlook for risk assets. Let's pause for a moment. The Fed will study the report alongside inflation readings and broader activity data. They will look for consistency because policy changes require confirmation. The latest reading aligns with their preferred path, yet it does not finalize any decision. The committee will keep a cautious tone because they want flexibility. Markets understand this dynamic. They know the report nudges expectations toward a softer stance while leaving uncertainty in place. Investors may position for gradual easing, but they also know the timeline remains fluid. This is an important point. Policy signals may emerge slowly as the committee watches how conditions evolve. So the path into the next meeting becomes smoother, but still dependent on upcoming data. The report reduces fear of a renewed inflation surge. It also reduces fear of an immediate slowdown. The result is a midpoint that supports stability. Markets now wait for the next signal. The latest jobs report reminds us that markets often move on small shifts in tone. The data did not show strength or weakness. It instead showed a slow adjustment that fits a maturing cycle. This kind of transition requires patience from investors. Let's pause for a moment. Long-term listeners know that the most important signals rarely appear in headlines. They emerge in trends that evolve quietly across several months. The current trend points toward balance, which reduces the risk of sharp surprises. That balance supports thoughtful decision-making. The Fed will continue its careful path and markets will adjust around each new reading. This is an important point. Stability builds gradually, and understanding that process matters more than predicting exact outcomes. So the report offers a calm message. The economy is slowing in a controlled way, and policy remains flexible. That combination supports a steady long-term outlook.